Good morning. It's the 9th of August, and this is Govindraj Ethiraj, headquartered and broadcasting and streaming from Mumbai, India's financial capital. The take. To its credit, the government is throwing everything it has at the jobs problem, hoping obviously something will stick. Let's go over some of them, at least the recent ones. For starters, the union budget allocated 148,000 crore rupees, or about $17 billion, to education, employment and skilling in the broadest of senses. The government will provide, among other things, a month's salary to youngsters joining the formal workforce with a cap, of course. The government also wants to reimburse employers up to 3,000 rupees per month for 2 years for each additional employee hired and who comes on the formal rolls. Now, the formal rolls are measured by their joining what is known as the Employees Provident Fund Organization, or the EPFO, which collects and stores your provident fund. The specific numbers don't matter because they're all in millions. Suffice to say that the government wants to incentivize employers and employees and also boost an internship program. In the case of internships, the focus is on spending a year working in a job environment rather than a classroom. It offers a monthly internship allowance of about 5,000 rupees. Over 12 months, that's worth 60,000 rupees plus an additional 6,000 rupees for incidentals. Now, the government will cover about 54,000 rupees of this. 6,000 will come from the companies themselves, or 10% of the internship allowance, and that can be housed under the company's corporate social responsibility budgets. Companies can also cover other administrative expenses. Now, the idea of internship programs, whichever way it's incentivized, is obviously that people will or should get hired or be in a better position to get hired after that, since they've got on-the-job training. And usually that's a gap for a lot of people who come out, or rather come into, the job market. Now, let me come to Reliance Industries. Why? Because it's the largest company by sales in the private sector. And while it employs less than, let's say, TCS or Tata Consultancy Services, IT services major, which is around 600,000 people, its staff strength is closer to Infosys. That's Reliance is closer to Infosys, which is around 315,000 people right now. But here it gets a little interesting. Reliance employed about 389,000 people in the year before, that's 22-23. And then the number dropped by more than 10% to about 347,000 in the last year, that's 23-24, or the latest financial year. So from 389,000 to about 347,000. Now remember, this is happening at a time when the company and its businesses are growing. Reliance itself says that most of the high turnover is in retail, especially store operations. Reliance Retail, by the way, employs about 207,000 people, but that number stood at 245,000 the year before. The interesting thing is, it's not that Reliance is not hiring as well. It actually let go some 143,000 people in the last year, but also hired 171,000 people in the same year. So it would appear that almost half of Reliance employees were hired in the last 1 year. Remember, the current total is around 348,000. So it is true that in retail, as in banking, attrition levels are high at the front end, particularly, or rather, especially in private banks, where attrition levels can range between 34 to 40%, which means that almost a third of the organization is turning over, though again at front end roles. For companies battling such high attrition levels, growth itself becomes a challenge. I can imagine every CEO or HR head pulling out their hair to find technology or other solutions which help them grow without having to deal with such massive attrition levels. AI, or artificial intelligence, and ChatGPT are obviously one such set of solutions. There may be more or may not be. And that brings me to the key point I want to highlight, which is that, saving some exceptions, there is considerable fragility in the job market. This fragility also means that the job market will not grow as we desire, even if companies themselves expand, add capacity, and grow. And these are, of course, the aspirational private sector jobs that one is talking about. Of course, the unorganized sector, which is more than 90% of the job market, will also grow. But not all those jobs will be aspirational. Now, IT services is a major employer in the organized sector. But as we've seen, almost all major IT services companies have been shrinking. It's not that they're not hiring, but they're again letting go more people than they are hiring. Equally, other segments of the IT services space, such as the captive global capability centers or GCCs of large multinationals, are hiring and growing. But industry voices tell me that the hiring amongst GCCs is not offsetting the losses in the IT services companies like Infosys and others. Also, skill levels will differ, so it's a more nuanced discussion than that. So the massive attrition and churn in some industries also suggests the problem with talent and fitment, whether with Reliance Industries or Infosys. And of course, the overall numbers also suggest that a major employment spike seems unlikely, even if incentivized by the government. As in, the overall linear growth figure may not really shift, or it may only shrink in some industries, while admittedly it will grow in others. So while businesses will expand and grow as the economy does and new manufacturing and services opportunities come up, there's nothing to suggest that we can solve our jobs crisis with a few brush strokes. Now, I'm not suggesting anyone is saying that, but this is a reminder that it cannot. We need more fresh ideas on what are the most ideal ingredients for sustainable new job creating enterprises, but we also need a patient approach both in policy as well as in practice. I use the word sustainable with some care because tens of thousands of jobs created by casino-grade venture capital in the last decade have gone because they were never sustainable in the first place, and no one wants to stay a delivery boy or girl for life. And our top stories and themes. The stock markets failed to hold gains once again, though 3/4 of global carry trade have apparently been removed. Will Indian markets get re-rated to new levels? The Reserve Bank of India holds interest rates once again. Which direction is it headed? And how slowing demand for Chinese homes is hitting India's steel industry.
This is the Core Report with Govindraj Ethiraj.
Markets fail to hold. There is a struggle in the markets quite evidently, with large, mostly overseas investors coming in to sell whenever domestic investments flow in, particularly in the last few days, and that's when sellers have gained ground. And that's been the case globally as well, as Indian markets are unusually tracking global cues more closely than we've seen in a few years, like they did in Thursday's trade. The residual impact of the yen carry trade continues, though. Bloomberg is reporting that JP Morgan Chase is now saying that 3/4 of the global carry trade has been removed. The JP Morgan team said that the spot component of the global carry basket would suggest that 75% of carry trades have been removed. So back home, the BSE Sensex and NSE Nifty 50 were down once again today. The BSE Sensex was down 580 points to close around 78,886. The NSE Nifty 50 fell 180 points to close at 24,117. The day was marked with fairly broad swings as buyers and sellers faced off. The larger question, of course, is what is the direction the market is headed in and where we stand? And I posed that question yesterday as well, and I will again today very shortly. Meanwhile, the Indian rupee has ended at its lowest closing level on record, and dollar sales by state-run banks, likely on behalf of the Reserve Bank of India, curbed further losses according to Reuters. So the rupee settled at about 83 rupees 96 paise against the US dollar, against 83 rupees 95 paise at previous close. Now, obviously, these are very small shifts, but it is inching closer to 84 rupees to the dollar, which is worrying some segments of the market, it appears. On the other hand, India's foreign exchange reserves hit a record high of about $675 billion as of August 2nd, the governor of the Reserve Bank, Shaktikanta Das, said on Thursday. The reserves rose by about $7.6 billion in the reporting week as per Reuters calculations, and they had fallen in the previous week. Elsewhere, consumer product sales slowed sharply to a more than one-year low from April to June thanks to softening demand for personal care products and packaged wheat flour, especially in urban areas, market researcher Nelson IQ said on Thursday. Overall sales volume growth slowed to about 3.8% in the second quarter compared with growth rates of 6.4 to 8.6% in the past 4 quarters, largely due to macroeconomic headwinds, Nelson IQ said, and Reuters reported. Nelson IQ also said that rural growth outpaced urban areas for the first time in 5 quarters, even as consumer product majors like Hindustan Unilever reduced prices to pull back customers. So where is the market headed? So this was all the macro backdrop, which we just spoke about, particularly on prices and consumption. And that also brings us to the opportune moment to ask, where is the market directionally headed, particularly since it rides on the fate or fortunes of the companies who we've been talking about? And what are the factors that are or will influence its movements here on? I put this question to Deven Choksey, veteran market analyst and managing director of DRChoksey FinServ. And I began by asking him also why the markets were struggling to recover from the drubbing that started over the weekend.
I think the past few years have been extremely rewarding years for the global market as a whole. It was in the backdrop of the easy liquidity which was created post-COVID, in which I think the market survived, not only survived, but I think grew exceedingly well, I think, in this particular period, because majority of the risk money came into the system and that got invested into the equity, including emerging market equity like ours. So undoubtedly, I think we have had the blessings of the significant amount of liquidity which came into the global system. And that created, I think, the kind of a confidence, credibility, euphoria, growth, everything. As far as India market is concerned, India market is distinctly driven by a couple of other narratives. The most important of being them was the government's commitment to spend a significantly large amount of money on infrastructure over 10-year period. And every successive years, I think they would increase the budget for spending on infrastructure, like the one which we have in the current year of around 11 lakh crore, which was earlier year, I think about 10 lakh crore. So obviously, I think the government wants to keep spending money on infrastructure, which is a good sign, because not only that creates the ecosystem in the economy for growth, but at the same time, it also pulls in significantly large amount of money from the global investors at the same time. And that's where probably I think our markets are thriving, growing, and reporting some significantly large number of growth numbers. Going forward, I believe that I think this particular situation would get little moderated, because in past 2 years, the growth numbers look very smart and handsome. Largely, it was because of the lower base. Today, the base has come up, and as a result of which, I think the same level of growth in percentage will not be seen, though in volume, I think it will be. So to an extent, I think I would think that the market would probably take a cue henceforth in getting little bit moderated, because of the growth assumption numbers on a higher base would look little tepid at this point of time, or maybe coming period as well.
Right. So if you were to look at the phase, I mean, now let me define that phase. So for example, let's say before elections, the markets were racing because they were expecting political continuity, and the political continuity has mostly happened, and they continued to rise. So there seemed to be a certain target, if, I mean, nothing stated, but maybe unstated. How would you relate this phase to? I mean, if you look back at previous cycles, is this a period of steady growth in the markets, or flatline to steady, including and allowing for the fact, as you said, that we have one big strong trigger, which is public investment?
Yes, I think given the fact that economy is growing at 7% rate and above, which means in a nominal terms, with inflation, it is around 11.5% plus. So obviously, I think this growth program in the economy is going to continue, as it can be seen from, or it can be validated from, the kind of spending program which the government has launched, both at the infrastructure level as well as the social infrastructure level and the industry level. So on that particular front, I would think that the corporate earning growth will probably be in line with the economic growth, or maybe in some cases, I think it would surpass the economic growth. As far as I think the ability of the companies are concerned to grow faster, it will probably help them even report faster than the normal growth compared to other peers in the same space. So I think the going forward, the program looks very, very clear to me that corporate sector earning growth looks, I think, pretty stable going forward as well. Maybe, as I'm making a point, in some sectors where even a lower base, where we saw the larger growth, that may not be repeated in the new era. And that is where I think the valuation probably would come to some kind of moderation going forward.
And could you share a few examples there as sectors when you say this?
Yes, I think today find that I think many of the public sector companies which have been driving the rally, many of the defense names which have been driving the rally, many of the railway names, capital goods names, I think have been driving the rally. Now, they are actually, I think, fundamentally not in question. Their fundamentals are even stronger than before. That is undoubtedly so. However, I think in each and every situation, if you find, say, for example, public sector undertaking, the stronger rally has been fueled by government's denial to sell PSU companies. That means the government created no liquidity situation on those counter, which probably resulted into buying with power by the money bag investors. Because on that side, I think when they saw the liquidity is not coming in the government side in the market, that means supply of people is not coming in. That is where probably I think they used that opportunity to buy into some of the public sector companies and created the valuation, which is far in excess of, I think, the growth these companies have been producing. Similar situation has been witnessed in the defense segment, or even railway segment, capital goods segment, or even contract manufacturing segment in electronics, I think, where probably the companies are reporting larger amount of under the PLI schemes, etc. I feel that this growth is largely backed by the higher number of, I think, volumes that we are given on a smaller base. But at the same time, the supply side has been constrained, which I believe is changing. Equation is changing to a greater extent. Private sector entrepreneurs have already started supplying new papers in the market. And as a result of which, they are also collecting or taking the advantage of the higher valuation, collecting more money for growth purpose. Public sector is still not doing it, but at the same time, I think the only liquidity-driven rally probably may not work. All said and done, insurance companies, mutual funds, provident funds, and the retail investors along with, all of them have been having higher amount of share in the savings which they are bringing into the investment market. So I think the narrative is basically all going to be on the valuation. Rest of the equation remains absolutely perfect as I see it.
Just to come back to the point that you touched upon in the beginning as well. So if we look at global markets and their ability to, let's say, influence what happens in India, that seems to have suddenly increased in recent days. Do you see that continuing, or do you see once again a delinking happening?
It's a good point to talk about, Govind. I think in the global market, the carry trade is not a new phenomenon. I think for the last 35 years, I may have seen this particular carry trade that's continuing. This time around, I think Japanese yen dollar kind of a trade which has been continuing, wherein people would borrow in Japanese yen and convert it into the dollar and buy the dollar assets, including emerging market equity, etc. Now, all said and done, this is a leverage position. And this leverage position is played very well by the traders. Those traders who are index traders, those who are ETF traders, as we call them in the global market as, those traders are borrowing money on one account, and I think they are using that money for creating positions in the other asset classes, other markets of the world. A part of it, I think, is becoming a situation where unwinding has to take place, largely because of the fact that I think in Japanese yen, you had a zero cost attached to the borrowed funds. The borrowed funds are going to be costing more because of the reasons that they are increasing the rate of interest. In my viewpoint, I think this kind of phenomena will keep coming and going. That does not affect the underlying the strength of the equity market, particularly equity market like India. Because I think, as I made a point, today 21,000 crore worth of new investment comes just by way of SIP in the mutual fund on every month basis. So whenever even the foreign investors want to exit, the traders want to exit, the local investors in form of the funds are definitely having cash money in. Another part is that the foreign investors who are exiting, as I made a point, they are traders, not investors. So obviously, I think it's not going to dent the situation permanently. At times, I think it will probably create a situation of sell-off, which we experienced about a couple of days back in our markets. But that doesn't last longer because the underlying fundamental, as I explained, in the economy and as well as in the corporate sector remains absolutely strong, including the liquidity factor in our market.
Right, Deven, thank you so much for joining me.
Thanks, Govindraj. Thank you so much.
The Reserve Bank holds rates. So the Monetary Policy Committee of the Reserve Bank of India on Thursday kept the repo rate unchanged at 6.5% for the 9th straight meeting with a majority of 4:2 and also decided to keep its stance of withdrawal of accommodation unchanged. The Reserve Bank's forecast for India's economic growth for 24-25, the current running year, remains unchanged at 7.2%, it said. The Monetary Policy Committee's projected inflation at 4.5% for 24-25, same as the previous projection, and more on that inflation number and, of course, the overall interest rate figure in a moment. So the Reserve Bank of India governor said a lot of things which I think are important, and let me take you through them. Firstly, he said that food inflation, which has a weight of 46% in the headline inflation, cannot be ignored. He also said separately that there is continuous concern over household savings moving towards alternative investment avenues, and he asked banks to mobilize deposits through innovative products and services by leveraging their vast branch networks. According to him, banks were taking greater recourse to short-term non-retail deposits and other instruments of liability to meet the incremental credit demand. This, he said, as he emphasized elsewhere, may potentially expose the banking system to structural liquidity issues. He also said that alternative investment avenues are becoming more attractive to retail customers, and as a result, banks were facing challenges on the funding front with deposits trailing loan growth. The alternative investment avenues, I'm assuming as most do, is either stocks or even for that matter, derivatives like futures and options. Banks, the governor said, need to focus more on mobilization of household financial savings and also spoke of the high growth in top-up housing loans and said that the regulatory prescriptions relating to loan-to-value ratio, risk weights and monitoring of end-user funds were not being strictly adhered to by some entities. He also pointed out that banks and non-bank finance companies have been offering top-up loans on other collateralized loans like gold loans. And finally, and not for the first time, of course, he flagged the issue of rising personal loans and urged banks to keep carefully monitoring the credit growth in that segment. He also emphasized the availability of accurate credit information, which is important for both lenders and borrowers, and proposed to increase the frequency of reporting of banks to credit information companies on a fortnightly or shorter interval basis rather than monthly today. This, he said, will help borrowers benefit from faster updation of their credit information, especially when they repay their loans. That, I can tell you, is something that I've faced as a problem as well. And the lenders on their part will be able to make better risk assessments of the borrowers. So let's return to the overall takeaways from the Reserve Bank of India's credit policy. So I reached out to Vivek Kumar, economist at QuantEco, and I began by asking him if he felt interest rates could have been reduced while it was not expected to, and thus what his take was.
Well, yes, completely along expected line, the interest rate announcement, which was unchanged, as well as the unchanged stance on the monetary policy, which continues to remain at withdrawal of accommodation. So as far as we are concerned, there was no need to dilute either of them. I do accept that a certain part of the market or participants, they were expecting a turn in the monetary policy stance towards neutral. But what we believe at this time is that there are enough uncertainties on inflation, especially on account of food. Yes, there are possible mitigants at the same time. So we do acknowledge a strong recovery in monsoon. The reservoir levels now look much better than what they were 3 months back. And there is an expectation of La Nina happening towards the end of August, which generally bodes well for good rainfall turnout in these. So all these are possible mitigants which are there, which have come up in the last 1 month. But the proof of the pudding is in the eating, Govind. So until and unless you see food inflation start coming off, I guess it makes sense to stay cautious and take the final step. Because the final step is something like, it's more like you would want to take that step when you don't want to make a U-turn. So you have to be 100% convinced that yes, inflation is coming off, and even the food inflation pressures, which are notorious as far as forecasting is concerned, they are also much better. So till you have that confidence, it's better to stay cautious.
Got it. The other point is on inflation, which the governor or the Reserve Bank is clearly projecting lower now. What's your sense? Is this based on food inflation coming down, or let's say maybe rejigging the very structure of measuring inflation or something else?
Well, there are two aspects here. One is that inflation will be lower in Q2, which is 4.4%. So first quarter of the financial year, we saw an average inflation of 4.9%. The second quarter inflation will probably moderate to 4.4%. And the subsequent quarter, it will again move up to 4.7%. The thing to note here is that in the next 2 quarters, which is Q4 of the current financial year and Q1 of the next financial year, inflation is expected to be lower than 4.5%. So at 4.3 and 4.4% respectively. So this is where I think the major comfort lies in terms of the moderating trend in inflation. As far as what's going to drive it, I think to a large extent, it's the monsoon-led cyclical support to food prices. And obviously, the lagged impact of past monetary tightening is still playing out in the background. So we still see bank rates, both on the lending side as well as on the deposit side, continue to reflect that transmission, which was undertaken in terms of actual monetary policy action. So these two are the major determinants. And last but not the least, the fiscal policy also Govind is playing a constructive role here, because it's not just the headline deficit which is consolidating. In the last 3 years, the quality of spending has been pretty superior. So I would say pretty healthy. And that both quantity of fiscal consolidation as well as the quality of fiscal consolidation is also leading to, or at least helping towards lowering some of the inflationary.
Right. Just to pick up on one or two other points that came up in the Reserve Bank of India statements. One was, of course, another alert that we need to step up deposits and bring in more household savings into bank deposits as opposed to going elsewhere. What's your sense? Is it an early warning? Is it is it a sign of concern?
Well, they've been saying it for some time now with respect to the gap which has emerged with respect to credit and deposit. So essentially, they've been highlighting that the credit deposit gap or the credit deposit ratio is kind of running at a level which is somewhat unsustainable in the longer run. So either you bring down credit or you increase deposit. That is the only solution to get it to more sustainable level. In the current context, obviously, RBI would not want credit to come down because they would want the sector, the corporate sector, the sector to gain from whatever lending operation that the banking system does. So they are egging the banking participants or the regulated entities to double down on their effort to increase deposits. A deposit also is a function of not just banks putting in their efforts, it's also a macro variable. There are also other variables which impact deposit, and foremost is the income growth, the GDP for that matter. So if India is able to maintain, let's say, a roughly close to 11% nominal growth in terms of GDP, then it should by and large be conducive for healthy deposit growth. Also, the RBI has, in its last monthly bulletin, upgraded their estimates for the natural rate or the neutral rate for India. Earlier, they said that it was close to 0.81%. Now they are saying it is somewhere close to 1.9. Essentially, what they're trying to say here is that the real policy interest rate in the economy is now higher, and the MPC would now be much more comfortable in keeping real interest rates at a somewhat higher level than what it was assumed to be the case maybe a year or two ago.
Right. Last question, Vivek. So, if you were to look at the last few credit policies, of course, there's no change for some time now in the interest rates. But how are you seeing the latest credit policy directionally? As in, are we just building on what we were doing earlier and moving along? Is it looking like we are directionally changing something? Or is it more sort of following a certain sequence, which seems to have been maybe set much earlier and therefore not much change?
That's a difficult question to answer, Govind.
In your sense?
In some sense, there is emphasis at a policy level to maintain macroeconomic stability. And this is getting reinforced both from every type of regulator. Look at SEBI, look at what RBI is doing, look at what the fiscal policy is. So every policy maker in their own realm, in their own sphere of activity, is emphasizing macroeconomic stability. And so is RBI. So RBI doesn't seem to be in a hurry to act in either direction because they feel that at the current level of interest rate at 6.5% repo rate, an inflation forecast of 4.5%, you're looking at a real interest rate of 2 percentage points. That's broadly consistent with their own estimate of the long-term neutral rate in the economy. They're also not convinced at this point in time that growth is feeling any scare. So look at the forecast. They are forecasting 7.2% GDP growth in FY25. That to me sounds like an outlier in the current environment where most of the market participants, including the government's chief economic advisor, would be in the 6.5 to 7% range. So they are above consensus in terms of their expectation of growth, which kind of gives them that extra elbow room to sustain with whatever they are doing right now in terms of both liquidity and interest rate policy. So they don't seem to be in a hurry. They are not in any mood to blink, and they would turn around or they would pivot only when they are convinced that inflation is much more sustainable at 4.5% levels.
Right. Right. Vivek, thank you so much for joining me and your time.
Thanks, Govind. It's a pleasure.
China's housing problem affects India. So China's slowing housing market is affecting domestic steel demand that's in China, causing steel producers who are shifting their output because I guess they want to keep their factories running to global markets, which in turn is causing consternation in many countries, including in India, where steel producers like Tata Steel are up in arms over low-cost Chinese imports. So that's just another day in a globalized world, you might say. Bloomberg is reporting that steel demand from construction is poised to shrink by 10% this year, which would lower the sector's share of total consumption to around a quarter, a very low proportion by the standards of the past 2 decades. ArcelorMittal, which is the biggest producer outside China, said aggressive exports from China are creating problems for the global steel industry and were pushing prices in the United States and Europe below cost. China's outbound shipments, said Bloomberg, are running at the highest rate since 2016. Maersk Line says freight demand is strong. Shipping giant Maersk, considered a barometer for global trade, is not seeing any sign of a US recession, which is also something that we should be watching out for, because according to them, freight demand is still robust. The company's CEO Vincent Clerc told CNBC on Wednesday. According to him, in the last few years, the shipping container market was surprisingly resilient to all the fears of recessions that there have been, and added that container demand was generally a good indicator of underlying macroeconomic strength. According to him, US inventories, goods being stored before delivery or processing, are a little higher than they were at the beginning of the year, but not at a level that's worrisome or that seems to indicate a significant slowdown in the offing. On the other hand, he said, and CNBC quoted, that they look at purchase orders from a lot of retailers and consumer brands that need to import into the US for the coming months, and that too seems to be pretty robust. That also should mean good news for Indian exporters or those who are tracking Indian exports, including in areas like garments and leather. That was the Core Report with me, Govindraj Ethiraj. Do stay connected with more of our coverage at the Core. You can check out our website or sign up to our newsletter for our exclusive stories, one in-depth feature a day on www.thecore.in. Do also track us on LinkedIn, where we usually post synopses or extracts of our top stories and interviews. We would love your feedback on how we can make business more interesting and relevant, including, of course, India's vibrant manufacturing sector. So write to us at feedback@thecore.in, and thank you once again for listening.